I think Edcon is like a really, really interesting thing to discuss because at its height, it was like the biggest non-food retailer in South Africa, and it hosted like a variety of names such as Edgar's, Jet, and At Home. And we're just looking at like the proceedings of what is happening now. I think I was having a conversation about it with Josh, and we're like, dude, this is like an amazing, complete like corporate finance case study because it's got like any and every principle that kind of goes into like a corporate finance case study. So like we wanted to tear it apart from like how it started and like the Bain acquisition and just kind of link it to like fundamental corporate finance principles.
So it's our first case study. Let's get it done, bro. I'm so excited.
This is our first case study.
We're going to publish this.
You know, and so Edcon, like I said, so we should actually like get started and just jump into it. Edcon, like I said, at its peak was like huge, dude. There was Edgar's everywhere. There was a Jet everywhere. Just used to go buy like just tons of stuff back there. Back then, used to go buy tons of stuff over there, dude. And so in 2007, Bain Capital, which is like the offshoot of Bain and Company, they saw like this super just outperforming just share on the JSE within retail, and they thought, you know what, we actually want to delist this and just kind of invest in it in an LBO, which is like a leveraged buyout. And before this happened, like I said, they had like a massive market share, dude. They were like a JSE darling, and they were growing at 5% per annum, even though it had been around for more than 70 years.
That's crazy,
which is insane, dude.
That's
like,
crazy.
I can't imagine just the growth continuously for 70 years and it's still growing at 5% per annum. And so they wanted to like go into the African market, which just seems like everyone's just trying to do nowadays. They wanted to pioneer that and be like, yeah, we're in Africa now. And so they identified Edcon as a nice target, and they acquired them for like 26 billion. 46 rand per share in 2000. Bro, 26 billion in 2007
yeah,
is
that's
wild.
a huge number.
26 billion in 2007 is wild.
Especially like the times we're in. That was crazy.
And just think about like the value of 26 billion rand in 2007, Randy. And obviously this was way overpriced. I think this was something like 51% overpriced. And to finance this, so to pay for this acquisition, they financed it through debt. And
boom, leverage buyout.
That's a leverage buyout. And that's really like, so what leverage buyout is just like a company, a private equity firm, typically they buy a company with a lot of debt. So, and they put itself as security, so the company has security, so they leave the company to buy it, and they have like a little cash injection inside. And they financed it through debt because typically, again, with the corporate finance fundamental principle, debt is cheaper than equity for like a variety of reasons. Like,
but just like to break it down, make it simple. All has to do with like tax deductibility and risk, so to speak, because the two options where you can actually finance, like general terms, is through equity or through debt, right? Now with debt, as Peter mentioned here, they use their shares as security, so it makes the risk of the lenders a lot lower than if it was just through equity, because they're the last line in terms of getting money back if, let's say, the business goes bankrupt. So that's why inherently like debt is just cheaper than equity without going into like fundamentals.
And typically, like it just costs less to issue debt than it does to equity.
Because it's the whole process.
Yeah, it is just the whole process.
Yeah.
And so when this happened, they were delisted and they were taken private off of the JSE. And honestly, I think they overpaid a 51% premium. Granted that there may be a control premium. So a control premium is like when you buy something and you say, because I'm taking control of your company, I need to pay you like an additional amount of money because I'll be like controlling your operations. And I don't know, man.
51%?
Half of, no, man.
Oh, man.
No.
So they paid 3 times. Oh, man.
No. And after that, they financed this whole operation because remember we said they issued debt. They decided to finance this just through foreign debt. So they borrowed debt in euros.
Why do you think they'd finance it through debt? Like, were they not sure of like the realization of, you know, their outlook on the firm? Like,
I just think because traditionally PE firms do finance stuff through LBOs and traditionally they are successful. I felt you were going to ask why would they finance it through foreign debt, and I just think maybe those are debtors they're more familiar with.
Also, because of they could borrow less
Yeah.
because of like the whole forex impact and
Yeah.
stuff, which we'll get into in a bit.
Yeah. But
But
they took out foreign debt. I think that most of the debt was in euros, and this exposed them to like a huge risk to
ooh,
another corporate finance thing, like interest and currency risk, which is huge. So interest risk is literally the risk that a country's interest rates on the loans will move against you and you'll end up having to pay more than you bargained. Currency risk is the same thing, but with currency. So the rand will weaken, the euro will strengthen, you have to pay more rands for your thing, for your debt, which is, do you think they didn't take that into consideration? Or was 2007 a rosy time because this was just before 2008 and the world
that's what I
was
was
just
gonna kind of
growth?
think. Don't you think it would have been safer to take SA debt at that time because we limited our exposure to the crash to a certain extent? We were impacted hugely by the forex impact, but like in terms of like our financial service has been really really strong and like they were really like strict on regulations, so like we were impacted quite loading then.
Remember, no one was seeing the bubble though around this time.
Yeah,
No one knew that
that would, I mean,
Armageddon was coming financially.
yeah.
And so I can imagine in their eyes, it was like the safe bet. It was like, oh, we're investing into a growing economy. South Africa in the 2000s, especially.
Ooh.
Yeah, they're investing into a growing economy, employing more people. We're more familiar with these lenders. I would suspect, I'm not too sure why they took out foreign debt, but I would suspect it's because
Yeah,
being
had
in an
more bargaining
international,
power.
yes,
Yeah, I also had more bargaining power
they can
there.
just, have favorable kind of terms.
Yeah, because I mean, coming in here, you're new.
Yes. No
You
one
don't,
knows.
you have no track
Yes.
history in
Yes.
the country, so it would be harder for them to get funding this side. Actually, if you think about that, that would be a consideration.
Yeah, I think that would be a huge consideration. So maybe, like you say, they have more bargaining power and they can negotiate more favorable terms, maybe ease up the covenants a bit. And most of the debt then did happen to be in a foreign currency, similar to our Cecil discussion, actually. But the difference being Cecil is a South African company.
Yeah,
But with Cecil, I would understand why they would take out foreign debt because they were building something
and
overseas.
yeah, so
and
foreign
so,
exposure. Yeah,
so they don't want
just
to,
match that. Yeah.
so that happens in 2007 and 2008.
Oh, 2008. Oh man, global recession. I think to everyone that doesn't know what happened in 2008, 2007, that's when the crash happened in America, which really just, I guess, catapulted and hit the rest of the world
Yeah.
to, it started off with Lehman when they went down.
Bear Stearns first.
Yeah, or Bears but Bears' impact wasn't that big.
Yeah.
I think when we really saw it was like when Lehman went down, and that's when we saw Edcon. Ooh, they got a big hit there.
And
That's-
also, load shedding started around that time.
Ooh,
I think
double
locally, load shedding started. Thabo Mbeki started looking shaky in his seat as well.
Yeah.
So the economy, this side, economic turmoil, just political turmoil,
Yeah,
and instability
political
was
risk
just starting to like
increasing,
root out, and like load
Yeah.
shedding was starting. And then there's this thing where the banks were misbehaving overseas. There's this person who loves saying that. What happened in 2008? The banks were misbehaving.
Oh man.
The banks were misbehaving overseas, and then it starts creating problems because it starts creating a weird macro environment for them
Yeah.
to operating. So like the rand starts depreciating, and like I said, it's the beginning of load shedding and
So a weak economy in the country, political risk.
weakening.
Yeah.
I think it was the first sign where, because SA was growing. In 2000s, SA was
Yeah.
growing, and it was the first time where we started to get shaken in the rand
Yeah.
response to that. And now we have this company that we've just acquired 1 year in, and it's massively levered.
that's
And it's massively levered.
and then the crash, and then oh man,
it's just
interest rate risk.
it's just, and those risks starts coming
oh,
into
man, yeah,
those,
that's
those,
saying.
those risks just really start coming into consideration.
Did they hedge those? You think back then they hedged those?
I'm not too sure.
Oh man.
It was also one of those things where hedging that exposure is very expensive and
Yeah,
it could
it
also
is.
sink them.
I mean, we'll have to also just, look into their risk management policy. But like, I think, they really got hit strong with that because, with the rand depreciating and interest rate risks are also factored in, and the weakening economy, and just I think the state of the global economy, it was just like they're getting hit from all sides, and now because of that, and people now spending more because changes in consumer behavior. It's like you had this fast growing company, well, this continuously constant growing company getting hit from all sides, and now your investment a year in isn't looking as promising anymore because of the economic climate.
And I think another thing, because post 2008 and just continuing, a steady decline started happening, right? And I think anyone who's ever taken a corporate finance course will know that like strategy is like the fundamental backbone of corporate finance. Like our corporate finance lecturer spent like a month teaching strategy because he believes in it so much.
Yeah.
And you see it in instances like this where he said to us, it's like a jealous girlfriend. Can't believe that.
Yeah.
Man. He said you treat it with care and you give it the utmost attention and it will do right by you. Or else there's nothing more dangerous than a woman scorned.
Oh man.
And the woman was scorned because they
Yeah.
have now this steady decline because of this weak macro environment, and just their clothes weren't popping anymore. I mean, post 2008, they started getting a reputation. Like, have you ever walked into a jet, dude? It's like old clothes. They never have size, dude. It's like a hip hop music video from 2002.
Yeah, man. Always got that vibe.
They just got left behind and they never
Yeah.
had sizes, dude. And with Edgar's, I know with like stuff that was like alternative to the LSM market, they started introducing the sale of like international brands
Yeah.
within their stores. And the thing is, with South African retail, when on a macro level, immediate brand recognition is a thing. So
Yeah.
if you have an international brand like Nike, that's like cool. We can kind of service that. But besides that, if there's no immediate brand recognition, it's very hard to introduce a brand to South Africans. So it's always better to
It's
stick to like home brands for profitability purposes.
Yeah, they always stick to like what we know.
Yeah. And then post this, they were also just experiencing like a year-on-year decline in headline earnings because they were just, especially when around 2010, 2011, 2012, when Zara, H&M, and them and Cotton On and they
Ooh,
started popping.
yeah.
These new
Big
entrants,
boys.
you finally had new entrants with like, because the thing is, before them, right, there wasn't anyone with the financial muscle to really challenge a Foschini, not a Foschini, but a Edgar's
Yeah.
or a Jet. There wasn't anyone who could come and number one rent a store within a specific
Yeah.
mall and kind of keep their cash flows up enough and kind of keep their inventory up enough continuously to kind of challenge them.
Yeah.
But then you got H&M and Cotton On, which I think is from Australia.
I might have to
Ahmad-
fact check that one. Cotton On, yeah, from Australia. I know.
Yeah.
H&M. That was
Zara-
also, I think, yeah, Zara. I'm not
Zara
sure.
is also an international
Clearly,
brand.
I didn't shop at Zara.
Zara's expensive. Dude.
Yeah,
Zara's
man.
crazy.
I'm not the target market, man.
And so these new entrants came in with this financial muscle I'm talking about, and they started selling all the cool clothing. They started selling all these NASA shirts. You see now, guys stop wearing NASA shirts. which
Oh
I
man, I
hate.
have a really nice NASA shirt. It's just,
They just started selling what was seen as cool clothing.
Yeah.
And like I said, there was this thing where like Zara and Cotton On and them are selling cool clothing, and if you go to a Jet or Edgar's, it's always like the same thing where you'd like, I don't know, get a plain white T-shirt that says I rock or
yeah,
cool
and
dude.
all those like this patterns and stuff.
And so if you fail to innovate, so if you carry on using the same business model, that's very surprising to me, especially in fashion, which is so forever evolving. We don't
Yeah,
wear
it's
stuff
like
we wore
continuous
2 years.
change.
Exactly.
Yeah, the only thing constant in the fashion industry is change, man.
Exactly.
Yeah.
It would be like for such a huge retailer, like a surprise to me to see them stay as constant to this day, Randy. When you walk into it, it's the same clothing. You know what you're gonna find.
Yeah,
dude.
I mean, I get all my jeans from Edgar's, to be honest.
You know. And the problem is, obviously, every company has this idea of growth, right? That they want to achieve. Growth is
Yeah.
another huge thing where you want to achieve growth, right? There's two types of growth that you need to pay attention to. Well, there's two main types of growth that one needs to pay attention to. And the first one is by acquisition. So I acquire someone and therefore I grow in a sense, which is what
Yeah,
everyone is
that's
doing now by acquiring
external, yeah.
the parts of Edcon. And the other one is organic growth. So just like me just growing slowly but surely every year and build a store here.
Yeah,
But to grow organically, you can't keep on doing the same thing over
yeah.
and over and
You
over
continuously have
again.
to find like new ways to innovate.
Mm.
Yeah,
And so they weren't really growing organically because they weren't innovating. So their market position was kind of starting to be threatened and was starting to shrink. And as well, Edgar started being known for like predatory credit practices. I don't know, like if you walked into an Edgar's in the last 5 years. My last experience there wasn't really amazing. I walked into an Edgar's and some guy was like, hey, do you want 2,000 off? And I was like, no, I don't want 2,000 rand off if it means I have to open a credit account. He's like, no, 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 it's not a credit account, I promise. And we walked into his booth and he's like, no, so you have to apply for credit. What's your ID number? And I'm like, but dude,
I just told
I
you.
just told you I don't want a credit account. And it became like known for like these predatory credit practices. And like over half of their sales at one point were just credit sales.
Yeah, I think I also had a bit of an instance where I think I was going to get jeans, supposedly. And they told me, why, like, you could always just get this on credit.
Yeah.
I was like,
No.
I'm okay.
Yeah.
Oh, man.
And also over and above this, in 2014 and 15, some debt started becoming due from what they had borrowed from the LBO. And the overall debt levels were like incredibly unsustainable, as you can imagine, because the macro environment is just carrying on being weak and weak and weak and weak and weak. And this kind of brings into like another corporate finance principle, which is like the effect of leveraging. And how lecturers like to do it is they like to draw like a seesaw, where if you put, depending on the lever of the seesaw, depending on where you put it, you can push up more. And so if you lever something and you're making profits, you can push your profits up really more, your earnings rather way more. But if you're making a loss, so if you're borrowing less than the cost, if you're making less than the cost of your debt, then obviously the lever is going to work the other way around.
Yeah.
It's going to push you up, mate. And that's what started happening. So like they had high overall debt levels and they were just unsustainable. And then they had to sell one of their stores, retailability, to a thing called retailability, which I think is a name that sucks.
Yeah, it's just, and I still is like,
It's
oh,
like,
man.
who calls the retail holding company retailability? But
Well, I think people need to hold on to this one because it's going to come back to bite us.
Yes. So they sell legit to retailability to raise cash, and this actually generates an accounting profit. So in accounting terms, with profit on sale of and so forth, they actually generate an accounting profit. But another thing,
In actuality,
another thing in corporate finance is cash is king. Guys, you're only alive for as long as you can stay solvent and liquid.
which is just like pretty weird, man. Like you can have really good financials, and like everything excluding your cash flow statement. Then you look at your cash flow statement, and that'll send you into bankruptcy.
Yeah.
Man.
I think that's why, especially for corporate, everything is so EBITDA driven. A lot of their measures are so EBITDA driven
because it's the most realistic measure.
Yes, they want to see just the effect of cash on your business and how you're handling that. And so they were reporting rather an accounting profit, but in realism, they were still kind of cash constrained even after the sale of retailability, and they sold it for like a large amount. I think it was like 600 and something million rand.
Yeah.
Of legit. And in 2016, Bain just decides, yo, man,
it's time.
We've had enough.
Yeah. I mean, they stayed there for quite a bit. And yeah, that's when they got out of the deal by swapping their equity for repayment of debt, right? That's called the debt for equity swap. And effectively, they reduced that debt to 6 billion and effectively making nothing from the investment. And they made an initial cash investment. I think we mentioned this earlier, that it'll because they bought it through an LBO, right? And then they had a little cash investment there that they invested, which is around 6 billion rand, and they weren't able to actually recoup that, and their backing for this and their claim for this is that it wouldn't be right to completely put the business under business rescue and risk like losing people, you're losing up to about 45,000 jobs.
Yeah, 45,000.
Yeah, so I think that was just the entire thing of like.
Do you think that's substantiated though? Do you think that tells the whole story? Because that sounds like a nice PR thing.
Yeah.
I would love to say, yeah, we had to get out, but we're not going to make the people lose their jobs, so we'll give it debt for equity swap. Do you think they could have done more? Because they really did leave this company. This nice performing company that they found.
I mean, if you look back at it, I think it sounds like a really good PR stunt, because then effectively you've come in, delisted it, put it in huge debt, and in the weakening economic climate that it's facing, it was Titanic waiting to happen. You know,
But I think 2020 vision, Rich, is like retrospective vision is very
always easier to
2020.
say
So
that.
like, yeah. Because I can see from Bain's position, especially, and that's the danger of looking from the outside looking in and not really being familiar with an environment. I can imagine from an outside looking in, like shares growing at 5% per year, companies continue to grow and continually performing well. I can imagine where we can say we can extract so much value from this.
Yeah.
But yo, I don't know. I don't know how I feel about their statement because it just feels like they're saving face for me because a lot of the problems that Edcon faced were a direct result of them acquiring them. And so to come out a couple of years later, nearly a decade later, and say, listen, we did all we could. We're kind of the good guys. I don't know how I feel about that. But
Because I mean, if they bought it purely through,
equity,
then we wouldn't have this
yeah,
financial issue
yeah,
that they've been
yeah,
having.
yeah. But they did come out and say, like you said, they saved 45,000 jobs, and
Didn't they really,
they did.
or just postpone the inevitable?
I can see at that point, yeah, you're all right. But they talked about like the vertical supply chain, which I think is something we don't take into account when we especially talk about like companies falling. It's just that everything else it affects.
Yeah.
So all the manufacturers, all the producers, everyone who delivers the clothing and so
Yeah.
much, just the whole supply chain, they claim they save 45,000 jobs with. And like you're saying, did they really just postpone the inevitable? Because post that, Edgar's continues to bleed out. I mean, they still experience like a steady decline in earnings, just year on year and year and year. And
Yeah.
then in 2018, I remember they announced like a rebrand, and they said that they were going back to the old model where they're housing everything in one store, like how the old Edgar's used to be when it was just a red square, I believe it was called. And in reality, it was really just for those of us who are really looking a function of like cost cutting. It's just like we're renting out all these shops with all these different things that house all these different things, and it'll really be cheaper due to
Yeah.
our financial position to put this all in one house.
Yeah.
And then I remember when 2020 started, just the week before they announced the lockdown, when it was inevitable, I remember the CEO crying on Talk Radio 702. And he was crying and it was like, oh my gosh, so many people are going to lose their jobs in Edcon because of this pandemic. And
Oh,
I
yeah.
remember the massive criticisms he received for that because it's just like, yeah, sure, so many people in Edcon are going to lose their jobs because of this pandemic, but you can't cry like it's solely attributable to this pandemic and not the
Yeah, because I
practices
mean,
of the company.
even before that, we saw the retail industry has been suffering for quite a long time. You know, so like as I said, like this was coming, and the pandemic just accelerated the further process that was coming because they needed to, I guess, sort out their financial position.
And then I think post that interview, we really like, I think we all knew what was happening at Edcon was ugly, but we really like after that, we're like, okay.
That's when like I think a lot of light came to
Yes.
it, and then people started actually looking at it. And then I know if you went to the stores post hard lockdown, it's also has a different feel to it.
I haven't been.
It's just
I'm one of those people where, because during the pandemic, they were like, post lockdown, everyone's going to stop buying online and go back to the store. I haven't stopped buying online.
oh yeah. Now for me, I think as there's some things they don't have stock. That's good as still.
I think also for me, because I'm a weird body type, I'm tall and skinny. I think some things I still do need to go in store for, like for jeans, for example.
Yeah,
I can't
yeah.
I can't just take a risk and be like, yo,
Let me, and that's exactly why I only shop at Edcon. 'Cause being 190 centimeters tall has its downfalls.
And so the front and center becomes we need to save these jobs. And now we see like a whole bunch of like corporate finance principles, M&A, corporate restructuring, and a business and financial distress is just like the perfect
A
case study.
dream.
It really is. Finance lecturers are probably going crazy right now.
Yeah.
Like, oh, what an amazing
If I was a
thing.
lecturer right now, you would see me.
Take the hint.
I'm so sorry for next year's students.
But then, yeah, obviously they need to, the number one priority, especially in this like economic climate, becomes to save jobs,
And as many as possible.
as many as possible. And so they now starts this process of kind of trying to identify buyers. of parts of the business to stay afloat and save these jobs, and kind of including saving the jobs of the vertical supply chain, like we talked about earlier. It's not that your jobs of Edgar's people are getting lost, it's jobs of the people who are delivering the clothing to Edgar's, jobs of the people who are manufacturing the clothing, the jobs of the people who are shipping this clothing over, the jobs of the people who, it's just so many jobs. It's just this whole supply chain of people before your pair of jeans gets to you. And so the front and center becomes saving those jobs. And so the first thing I saw, I remember, was the Foschini Group, which is known for like Markham, Sports Scene, Total Sports, and so forth. There was like another huge retailer within the market. They bid to buy Jets around 450 million rand, which is funny because apparently there was this thing going around that apparently they bid a couple of years ago, and they were quoted at 4 billion rand.
Ooh, almost 90%. Oh man, must have been a steal.
I could imagine they were so happy for themselves.
90% down.
It was insane, Randy. And so they bid to buy Jet at around 450 million.
That's downright disrespectful.
And in this bid, they're bidding to buy for the Jet brand, which is like an intangible asset. It's this thing that you can't touch, but it's there, and we're buying it.
It's kind of like let's say you own a Samsung or an Apple, majority or Mercedes. People usually you're buying it because of what it is, not because actual equipment, but like the status. Yeah.
And so they bid to buy that. They bid to buy 420 stores. They bid to buy the associated property, plant, and equipment, and the distribution center. The rights to the Jet magazine, which I don't know who reads, but I guess
I've never heard of it.
I've seen it before.
Oh, okay.
I've seen it at my grandmother's house, I guess.
Yeah. Target market.
The inventory and the key selected executives. And the key selective executives for me was very interesting because it brings into this account this kind of discussion on synergy. And basically what synergy is, a lot of people like explaining it as 1 + 1 is equal to 3.
Yeah.
Where you combine two things that are very like together, like a Jet and a Foschini. And because there's already so many common operations, like everyone has like a distributor, so they can use the same distributor and stuff. They can cut down on a lot of those and do a lot of cost savings.
And I think to add on that, like let's say, to give an example, with a synergy which would arise from keeping key selected executives, is that employees lower down in the chain would trust existing management. So by you keeping some of the same management, you'd able to get employees buy-in so that your productivity doesn't go down because they don't feel like there's a purpose or anything like that. So that's just a small example of why they would also keep. And also another factor would be that they have experience in that practice.
Yes, I think that's a huge one.
They would provide you a better view in order for you to make a return on your investment. So it's just another way to look at it.
They just come with a wealth of experience.
Yeah.
I mean, they've seen this company at its topmost and they've seen this company at its lowest. And so they can kind of navigate around it and kind of identify what kind of went wrong. And that's a huge value add because you don't have to start from the beginning and start poking holes at stuff. And the Foschini Group still plans to invest an additional 120 million rand into the business to properly merge and integrate the business into the thing. I wanted to ask you, do you think this was factored into the purchase price? Because
and
why
the purchase price was 450 instead of anything higher?
I think because basically, normally what happens is in these type of transactions, it's not really just the one price. There's just like a range of prices. So a valuer will calculate a minimum and a maximum price that they're willing to buy and sell a company, right? And they would normally negotiate within this range. And the maximum price would obviously take into account the fact that I may need to still pay more money to kind of, it's like buying a house. If I buy a house and the person says it's 5 million rand and I come in and I say, but I need to come in here and fix the taps on this leaking roof.
Yeah.
And this is going to cost me, for example, 200,000 rand. I'm not going to pay you 5 million rand because I still need to come in and fix this. So we'll probably drop that maximum price down to 4.8 million rand.
Yeah, to factor in that additional.
Do you think, because it was interesting to me, do you think they factored this additional 120 million and brought the price even lower? Because to me, the price is already so low, Randy.
That's the thing. I think, to be honest, I do think it was factored in, but also in the sense that they're getting it for, again, almost 10% of the value of which they bid it like a couple of years ago.
Not too long ago.
So it's like already you have a huge steal, but then now you could even you could further decrease the price even more because also given this the situation, the state of economy, this needs to happen. So this isn't a thing of like, oh, they have time because they didn't have time because it was during level 5 and level 4 lockdown where all these negotiations were coming through. So they had leverage to do that. So I do think that it drove down the price a bit more.
I think it
actually.
also brings in like another cool corporate finance principle, which is the realization value of things. So if you're selling something under pressure, obviously you don't have the time to kind of get like a nice valuer and kind
Yeah,
of
so it wouldn't be
shop it
a
around.
fair value.
Yes, it wouldn't be a
Yeah.
fair value. It's just that I need to realize X amount right now.
Yeah.
In this case, to save jobs and so forth, and kind of to stabilize this situation that's going on right
So
now.
then the value, I guess, we could say that the 450 million is would be a market value, and that's the value of which a willing buyer would be prepared to buy the product. So the Foschini Group were paying that 450 million would be a market value because that's the value that they were prepared to pay for it, as opposed to that would actually be of a discount of the fair value, which is the price that any willing buyer in the
Buyer in this
market
case,
would
yeah.
pay for it. So yeah.
And so I saw 2 weeks ago this acquisition was given the green light by the competition tribunal. Besides, like the following concerns being raised, which I want to talk about as well. Mr. Price said that they're going to get an unfair competitive advantage because they have more stores in a single thing now, and now they can like negotiate lower rent because in a sense they're renting in bulk because they have like a higher proportion of floor space within certain malls. And the court held that their market position is not really large enough to effectively give them a larger competitive kind of advantage. I agree with the court there. I don't think Fashini acquiring just Jets is going to make like their relationship
Unfair.
with the mall.
Yeah. If it was like the entire Edcon,
Yes,
you
then it would be
could
like,
argue.
okay.
But I mean, they'd have to do that though.
Yeah.
I mean, it's a fair claim by Mr. Price because
I
again,
think it may drive their rent prices down. Yeah, sure.
Yeah.
But not so much so that it gives them like an entire unfair competitive advantage.
yeah. So it will obviously come to the benefit, and these are one of the synergies that
Hmm.
we spoke about, and this would be a recurring synergy because of this acquisition, they greater market share now. They would be able to negotiate lower rent, and this would result in cost savings. So this would be a cost saving synergy for all of those. Just for further context.
And like the Fashini Group, another argument was the fact that the Fashini Group is inheriting like 800 million in inventory that is effectively not paying for because Jet cannot pay for that inventory from their suppliers. So in a sense, they're getting, because they were in such a shaky position. So in a sense, they're getting that inventory for free. And the court held that, and as well, the court held that because TFG, the truest Fashini Group, thought that this 800 million cost 800 million, but it's not what we can realize from it right now. A lot of it we got pre-lockdown, for example. A lot of it's from pre-lockdown, and it's not seasonal anymore. It's out of season.
But still, what realizable value of that? Let's say it's 200 million.
It's still a lot. It is still
That's
significant.
200 million.
It's half of the purchase price.
Exactly. So I mean, that's that. I stand with them. That's fair. I'm sorry. Like the realizable value from 800, we can write that onto 100 million. That's
Still fair. Actually, I actually didn't look at that like that. The court also ruled that it's really an issue between Edcon and the suppliers of credit than it is. It has nothing to do with TFG. So, because Mr. Price argued that they got it for free because they didn't pay the suppliers because they were in a weird financial position. The court was like, but that's not an issue for TFG. That's Edcon and their
it's
suppliers.
Edcon.
And I think that's what I agree with too. It's,
I stand there.
they have nothing to do with that. And then after it held this, amongst other things, they gave the following conditions to the merger, which I think were very important personally. They said that they're not allowed to release any employees currently employed for a 2-year period, and they have to keep the same ratio of products procured from South African suppliers from the previous financial year. And I think that's really, really fair. I think too often we see companies buy into other companies and kind of chop and change and take the short road, and the result of that is like massive layoffs and stuff
Yeah.
like that. And I think the whole point of this transaction was really to save jobs. That's what everyone has been saying. That's what TFG has been saying. So it'd be very hypocritical to hire them and say, listen, we only need 2 people per branch now or something like that. And
It'll go against the entire purpose of the transaction, why it was approved.
yeah, it would I don't know, it would seem fishy for me. It would seem like they procured them to kill them off or something like that.
Yeah.
But even the same ratio of products procured from South African suppliers, I think is very good. So it kind of prevents them from going, okay, cool, thank you. Now we're going to source everything from China. And just South African supply chain, like we're talking about, is now kind of screwed because a new person purchased us. Yeah, we're excited, but we're not getting a piece of the cut anymore. So I think that that's very, very fair. And as we said, this acquisition will save 4,800 jobs just initially, just directly, which at the 420 jet branches that will stay open, 382 in South Africa and the rest in SADC countries, which I think is so important. I think it's so important to keep those open and keep those jobs opening. And according to TFG, the strategic reasoning for the acquisition, I don't know how I feel about this too. They came out and they said the strategic reasoning was because there's an accelerated market for fewer fancy clothes and more casual wear.
I think this is actually like, it's quite honest. To be honest, like if I was thinking, okay, myself currently, the last time I had to wear
A suit.
actually was quite recent, but before that, it was like interviews in like March or Feb.
But the world's opening again, Randy.
But like, how often have you seen people go back to like complete normal? You know, it's still taking time, and people will still have their drawbacks and reservations.
So, do you think this is a good strategy for 2 years from now? If we just focus on
I actually think this is actually it's quite fair because let's be honest, I don't think we're gonna see 100% people ever go back to work.
Okay.
Because we saw the impact of actually working at home and what it does for people and the benefits of it. I do think with even office space, that's going to go down more, and we'll see a thing where let's say half of the workforce goes to work one day, and it's a rotation like that. And if you have a rotation like that, I mean that is true. You're going to be at home, so you're not going to be wearing a suit at home. I mean we all seen that whole narrative, like you're on a Zoom call and you have your PJs on at the bottom, and it's like a fancy shirt on and a little blazer on.
I have a friend who was on a Zoom call and he didn't realize he was wearing a durag until like halfway through the Zoom call, and he was like, "Oh my gosh, I'm wearing a durag."
A wave check mood.
And I died. But I think the other part of the strategic reasoning, which I also agree with, is like they predict that this market for affordable clothing will grow as South African pockets shrink as a result of like the dire economic conditions. Obviously, everyone will kind of shift to more, especially with Jet, because they serve that market at LSM, just kind of lower middle class and less fortunate people type market. And they say that it gives them like direct access to this market. And I agree with this fully. I was actually talking about this with a friend of mine, and she was asking me, but like, dude, everyone's going online. And I told her, like, think about like the general populace of South Africa. Like, we're going online. Yes, we're going online and we're buying clothing online and so forth. But same with like Capitec Chat, the general populace still relies on just branches. And so I think, especially you see like where jets normally are. So like taxi ranks or like a plaza and like a township and stuff like that. I think those market segments will still kind of continually need jet.
Yeah, because it's like the whole thing of like, even we have the conversation of the fourth industrial revolution, but the issue is that we don't have the infrastructure, and nor do we have the people that are willing to shift right now. Because I mean, what do you trust? You trust people. So a lot of people don't trust tech. Right,
really
anything
don't,
online, and even the reluctancy of people to buy online because of certain fears. So I mean, this is quite fair.
So you think this is like a feasible reason to purchase a whole chain of stores?
Honestly, I think the main driver is the fact that we're buying for close to 10% of what we bid for like a couple of years ago.
It's an increase. That's a huge value add.
Yeah. So for me, that's like, it's not even that's insane.
That is really insane. And post merger, and I saw this, and this has nothing to do with, I would suspect, the acquisition of Jet, but they've been wanting to do this. Post merger, the Fashini Group want to switch to like a local manufacturing supply chain as a result of, amongst other things, the creation of employment,
Synergies ringing everywhere.
deglobalization. And I think that comes with, because we've seen how a dependency on China to kind of import clothing, especially in conditions like this, should we have maybe like another surge and borders close again. There was a time for 3 months during lockdown, there was no new clothes, dude. Like I wanted a hoodie. I couldn't find a hoodie I liked. I was like, guys, what's happening? Where are all the hoodies? And I realized there's no clothing coming in from China, just from
Yeah.
general imports. And so maybe to curb around that and the uncertainty of the trade war, which we also had a conversation about a month ago, a couple of weeks ago. I can't recall. And so they currently employ 550 people locally. I'd imagine that would increase with the distribution center they just acquired from Jet and their property, plant, and equipment. And they currently wish to like kind of grow that. Do you think a highly South African dependent manufacturing environment is a good strategy? I think it's good for employment, but do you think it's good strategy?
I think
I think because for me, how I look at it is if we import stuff religiously from China, obviously South Africa is always more beneficial for South Africans. But and then we stop and we say, no, because of COVID, we don't know when this might happen again. This is a once in a lifetime kind of event in a sense. Do you think we're over hedging ourselves?
I don't think I don't think it's actually a once in a lifetime event. I think history. So sorry to be that guy, but history tends to repeat itself, and I think
Dude, we
it's,
haven't had a pandemic since like the Spanish flu in like 1920.
but we're here. It's 2020, and it's a pandemic.
Like literally 100 years ago.
Hey, listen, if in 100 years there's another pandemic, they would have hedged it because it would have been around for that long. But I think it's good though because we are seeing deglobalization in a lot of material aspects and a lot of industries. So with the outlook, and again, it's one of those synergies I spoke about. I mean, look at the inventory thing with the 800 million, a huge discount buying this at 10% of the value. And now they have the ability to expand their operations, right? Because now them wanting to switch to this whole local manufacturing supply chain, they can go into a whole form of expansion, which is external, which is vertical M&A, which is now acquiring people in your supply chain and now expanding that. So now you're expanding your footprint, and also now you can realize other synergies from there from cost saving because now you control the people who supply to you.
Do you have monopolistic concerns?
Definitely. That's where I was going to go to. This. Yeah, definitely. And I think that's also another thing that they saw that we could actually get into this, and the impact there would kind of lead us to our next topic. And that's the person we all forgot about, the person that they sold to, and relatability, retailability buys Edgar's.
Retailability is crazy because they're so low key because they bought Legit a couple of years ago. They came into the spotlight and then they went away. And then
when you need them again, it's like Batman, man. They come out only at night, man.
They came again. I think they're backed by a PE firm called Metier. I don't know how to pronounce it.
Yeah.
And now they're buying Edgar's. Like, I know they own Legit Beaver Canoe, which I've never heard of.
Same, the brands here I've never heard of.
Style, I've seen like one store somewhere.
I've never heard of
And
it.
apparently they typically LSM type investments, so like for lower and less fortunate people and in that target market and like a tax rank and so forth. And like I said, they bought Legit in 2017 for 637 million when Edcon was trying to strengthen the balance sheet. And now they're buying Edgar's for an undisclosed purchase price. The CEO said we're a private company, and so we don't have to disclose how much we bought it for.
I want to know that purchase price.
I also want to know that purchase price. And he came out, he gave an interview. It was the craziest thing. He gave an interview. He refused to be taken a photo of. He was like, no, he doesn't want the focus to be on him. He wants the focus to be on the business. And I'm like, wow, he's just really spooky.
Yeah. Mr. Mysterious.
Mr. Mysterious is like, ooh.
Yeah. I'm going to do some research on this company. Oh, we should do this next week.
And they say they're based in Durban. And that's just...
It just adds on to this mystery, man.
Financial services and just stuff like that normally based in Cape Town or Sandton or maybe Randburg.
Yeah.
They're based in like it's just so mysterious.
Everything is just, oh man.
And so they say they're attracted by their strong brand, their customer loyalty, and an access to a market they currently don't operate in, which offers an enticing growth prospect. So again, they're chasing this organic growth. I mean, this growth by acquisition where they're acquiring something in a completely different target market to kind of grow in there. I mean, in a completely different market segment rather, to kind of grow there. And they claim that they're only taking on Edgar stores that they feel is sustainable from day one. So from the day they purchase it, they can open it and they can operate. And so they've thus purchased only 130 stores, of which 120 in South Africa, which obviously 10, I suspect, being in other SADC countries. And the interesting thing for me with this is that retailability is taking on 5,200 employees, effectively like doubling the size of the business. And so my criticism is retailability not doing a thing where they're a smaller fish swallowing a bigger fish?
Yes, sir.
Isn't that? I wonder how much strategic consideration. We say strategic consideration a lot because it's really important to strategize about every decision you make.
And the impact on that.
I wonder, like, if they said, isn't it scary, Randy? Because a lot of the other legit Beaver Canoe and Style combined aren't as big as Edgar's.
My thing is,
And they're in a completely different market segment.
this heavily links to how much did they pay for this?
Why do you say that?
You just doubled your business.
Effectively.
You had a press conference which you wanted no photos. You're saying that you don't have to disclose the price because, well, you don't really have to. And you only take on stores which, in your view, are sustainable from day one. What about, because all I'm saying is, the jobs that they wanted to save was what, 45,000, right? Effectively, if my numbers are correct, they only saved 10,000.
We don't know what's going to happen with the others. So we don't know.
35,000 jobs.
We don't know who's going to maybe come in and buy the others.
But so now the non-sustainable stores, in their view.
But can we put that on retailability? Because
No. It's a fair argument they made on their side, and obviously, I mean, it's their investment, and they have every right to do that. I think it's in their best interest. It's just now we have to take into consideration the country we live in and how much consumers appreciate transparency because of our history, with a lack of transparency. And now, for me, this from that aspect, from a humanitarian perspective, an ethics perspective, I want to know more.
I don't think it's non-ethical. I just think they don't want the focus to be on them. I think they want the focus to be on the business. I strongly do believe that. He's just like, he doesn't want to be a celebrity. He doesn't want to be Elon. He doesn't want to be a celebrity CEO.
Yeah,
I just think he wants the focus to be on the business and the business's operations. I think my concern is you're taking on a thing that's going to double your size in a market segment you've never operated in. And this is a business in distress. So, again, you're taking on a business in distress in a market segment you never operated in.
Red flags.
And so,
but
also,
I think
these people are not... They're aware of this, Randy.
Yeah.
I don't think they're just making reckless decisions. I think they're aware of this. So I think for me, it'll be interesting to watch strategically what they implement to kind of
and how it evolves
to kind of kick this off. And the CEO, again on synergies, Mr. Drillman, his surname is the CEO of Retailability. He's had like various stunts at like various retailers in different capacities, including Mr. Price, Edgar's, and another couple of like retail companies. And he's thus like, he feels, and I guess the board behind him, they've identified opportunities within these segments and claims that the group already having like strong brands within the lower market segment, they can utilize this knowledge that they have within these strong brands to kind of filter through to this different marketing segment. And I think this is also an additional management synergy and some as well horizontal mergers and acquisitions going across where it's kind of people in the same industry but just different market segments to capture more of the market. And they also announced that they were exiting the homeware department from it because the guy just said like wanted to be known for his fashion. He's so mysterious. He's like, we want
someone wants to be known for his fashion.
he's like, we want Edgar's to be known for its fashion. None of that home thing. So they're exiting like the home and lifestyle part of it because they just want to focus on clothing.
So then, like, what's gonna happen to the rest of the stores in the home? It's just, oh man.
I can't blame them. I think in this context rather, beggars can't be choosers. And if them I mean, they're called retailability. As a retail company, focus on retail. We can't fault them for be like, hey, dude, why aren't you selling pots and pans? Why aren't you taking on pots and pans
Yeah,
if
I mean,
that's not
it's
part of their
fair.
strategy?
Yeah.
So I think fair game to them. I just think it's going to be very interesting to watch how this unfolds. And I just want to ask before we kind of like close off, because we've discussed the whole deal now. It also would be interesting to see if there are any more takers for any of the brands under Edcon. What do you see for the future for both of these brands that have just been acquired? Do you think they can? Do you think they can kick up the dying horse?
Well, effectively, they've just taken the heart and the brain. That's what I see.
I don't know.
I don't know. I think it's a tough one. I think I'm gonna hold my comments. I need more information.
I just think it'll be. I think whatever happens with these two, I think number one, it'll be interesting to see if both of them succeed,
And how it plays out.
how it plays out. I think if one of them succeeds and one of them fails, it would be interesting to see why it happened. And I just think this is one of the case studies future scholars are really going to learn and divulge
Bro,
in. I
this
think
is
this
quite beautiful.
what's happening right now and what's yet to happen 5 to 10 years from now with all of this is going to be a huge case studies for future academics and future scholars within academia to kind of divulge into. And I just think it's a really, really cool and interesting transaction, man. I really do hope they can save as much jobs as possible, especially within like these dire times. And I think that's a wrap for today, man.
So, guys, I just want to tell you a couple of things. Firstly, thank you for giving us a listen. We have a weekly newsletter, so you can just pop on any of our social media platforms, go to the link in our bio, and sign up for a newsletter. This is the main podcast channel, which is the FinChat podcast. So definitely go back and listen to any of our previous episodes if you haven't to already. And we have a personal finance segment, which I run, which comes out every 2 weeks. We're almost finishing up with season 1, which is tremendous.
Yeah, it
so go
really is.
check that out. And there's another podcast, and Phila has the best joke for this one. So,
Yeah, it's called Startup Stories. It's really about startups and their stories.
Oh, man.
And it's run by Josh, who couldn't be here today, unfortunately.
yeah.
Also, some interesting guests over there. They concluded season 1
And
a
then
couple of weeks ago. Please
Yeah.
do check that out too.
we have a very interesting newsletter guy, the fourth member of this 5-headed dragon, and really, really cool like stories he puts up. And also check out our LinkedIn. We have a lot of our stories from lockdown and a lot of conversations like this, which we started up, and we've kind of come full circle to discussing so many aspects. And that just speaks to, I guess, also our involvement from what we knew at lockdown level to what we know now.
yeah.
And like how we were able to come full circle.
How
and
we're
discuss
growing
these.
with you guys,
Yeah,
actually.
so it's like it's a really nice journey, but I mean it's nice to hear it all now. But go back and listen to like our first couple podcasts and how that's sounded and how it's gone back. Thank you so much for listening, and we'll see you again in another 2 weeks.